When you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. When you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. First off, welcome. I have a feeling that you're going to either leave this session that we have and say to yourself, whoa, that makes a lot of sense. Like, a lot of that stuff is clicking, and you're going to start to become a little bit of a, an addict. You're going to start going through millions and millions of charts, which to me I think is a good thing. I think that level of practice is only going to expedite the process. Or you could be in the other part of this where you see it and you say, there's no way I'm ever going to get to this point. I'm done with this shit. I'm quitting, right? And I will say that it doesn't happen all that much, but if you do feel yourself kind of feeling a little overwhelmed, that is okay. With time, it's all going to come together. Tonight, we're just doing really basic brush strokes on some of the key concepts. I know I spoke to a few of you. You've already, watched some of the videos that I had made on them where they get much more in depth. To me, this is step one. This is really just entry level. Like, you're going to hear me say these words, at least kind of have somewhat of an idea as to what it is. There is a very regimented process here, and the beauty of it is each specific model that we're going to talk about, because realistically we have about 4. You don't need to use all of them. You don't need to use any of them for that matter. You might find something in what I'm showing you here that resonates well with you and something that you can build off of and create your own thing, right? You really don't have to use any of mine, right? I know a lot of people in here do use the Mando model and the London kill zone specifically. A few use the odd NAM, which is, we'll get to it, but just basically the inverse of our Mando model as it is. And then last but not least, it's kind of the ICT unicorn. So it all comes together there. You guys can all hear me now? Eva, you good? Let's see, I just saw those messages. Yeah, I just want to make sure you guys can all hear, and then we'll get into it. Let me just make sure he's good before we roll on here. But like I said, everything can really be segmented into, whichever one of these concepts that really click with you, and you can kind of create your own thing. And now the beauty of this is whenever you do ultimately create your own model, it's not some, pardon me, not your bullshit moving averages that are going to change all the time. It's not something that you can't go back in time and back test. This is something that you will be able to back test every aspect of said model in order to create something that, one, you can prove is, prove success with. But in addition to that, it's something that you will have a lot of confidence in, and when you have confidence in something, odds are it's probably going to work out much better for you when you actually trust it, right? Because to me, there's 3 stages to this, and it's, first, you kind of have to have a basic understanding of the concepts. this I don't think is going to take all of that long. I think by the end of tonight, you guys will, and this is only really going to be an hour. It's nothing too crazy, but by the end of it, I just a little bit of familiarity with it will definitely go a long way, because the next step really is to be able to start to see it. You start to see how price reacts to certain, whether it's an imbalance, whether it's an order block, whether it's a breaker. You see in certain market structures which imbalances would be more preferable in that situation. You look and see how price. When you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. Reacts to liquidity. Once you start to see those things in hindsight, that's a very good sign, because ultimately you're not going to be able to anticipate price and see it before it happens if you can't do it in the past, right? So again, it's brick by brick. It's a stepping stone. You don't want to rush too much into this. Get the concepts down. I'm going to show you, and hopefully by the end of tonight you're going to say, oh wow, I see how this works, right? That's the goal. And if that works for you, slowly but surely, with more practice, it's all going to come together. We've had hundreds and hundreds of success stories throughout time in here. With we have over 100 past demo accounts for funded trading, where you now are, you don't have to risk your own capital to trade anymore. 100 people have gotten that right to this point. How many have kept it? We'll find that out shortly, but that's in itself a stepping stone to prove to you that what you are doing is working. How can you be more efficient so that you don't lose that account, right? Or even if you're trading options, right? Same type of situation. How can you get your model to a point where you are consistently making money and not giving it back immediately, right? That's the goal. So, to build off of those three, first you got to kind of have an understanding, then you see it, and then you can anticipate it. Those are really the 3 steps. And overall, you're going to hear me talk about 3 main concepts that ultimately come together to create my trading model, the Mando model. Okay, the first being imbalances, second being liquidity, and third being market structure. Right, all combined, that's where you get the Mando model. Okay, so let's just go back in time a little bit and we'll take a look. And first off, I'll start with imbalances. This is very important because the imbalance itself creates the entire makeup or trade plan associated with whatever we're looking at, right? Without the imbalance, for me, there's no entry, right? Without the imbalance, I don't know where I should be placing my stop loss so that I do not get smacked if it goes against me, right? Really, without the imbalance, there's no trade for me, right? And there's certain situations and certain times throughout the day where you're going to notice, oh, okay, I can see it setting up. It's coming down to that imbalance. It's not quite there. I need to wait, right? So it's even giving you that, like, I guess that little bit of a compass in terms of like, okay, I need to wait. There's nothing here for me, right? And to me, defining that prior to anything is very, very important. So we'll use this previous example on NASDAQ, as the basis for our idea here. But we'll draw our range. We'll get to that in a second. But the idea behind the imbalance is it is a specific region on the chart, okay, where you have an imbalance in price in one direction, while there's an inefficiency in the other direction. What do I mean by direction? Whether it's up buy side or down sell side. Okay, so when we see, and this is simply put what it looks like, and again, you'll probably be able to do this in 10 minutes, right? You were to look at a specific candle, okay, any of these candles, and what you notice is that on either side of this candle right here, there are no wicks on either side of this up close candle, right? From this point here to this point here. That is an imbalance. There is an imbalance in price in that specific region. Why? Right? So, to use terms that I don't, really completely buy into these ideas, but there's, an abundance of buyers and a lack of sellers in this specific region. There weren't even enough to get up into this specific region on the chart, and this ranges from 381 to 144, okay? Now, the way that we look at this is inside this area, right? Think of a teeter-totter or a seesaw right at the park. You sit on one side of it, naturally the other side's up in the air, okay? Now, every time price gets back into that imbalance, it's like throwing a sandbag on the other side. So over time, that area is going to be balanced. But one sandbag of 40 pounds and you're sitting on the other side 180 pounds, that's not balancing that range. So what we would anticipate is that when price hits that imbalance, right, we are going to hit it and take off. We don't really want to sit around in there too long. We want to get in and get out as soon as possible. Okay? So again, wick, body, wick. Okay? One more time. Wick, body, wick. Okay? Price gets into our imbalance, price gets out of our imbalance. Okay? This is literally exactly what we want to see, right? We want to see price get in and price get out. Now, with that being said, that's a bullish imbalance. I'll show you what the bearish imbalance looks like very similarly. Here it is. So ready? Wick, body, wick. Okay, no wicks on either side. We would anticipate that when price gets into this imbalance, that price is going to get in and get out. Okay, here it is. Ever so slightly. Let's zoom in here and look at this. Price gets in, price gets out. Okay, that's exactly the most ideal situation we have there. Now the beauty of this is, obviously, with more time you'll buy into it, right? But I can tell you, and if you take my word for it, this works. Price gets in and price gets out. There's a few little things that we'll get into as to what imbalance is more likely to be successful versus lower probability. We'll get to that in a second. But the beauty of these imbalances are that when you have one mapped out and there's one that's specifically catching your eye, not only do you have your entry mapped out, right? Ideally, you want a long in a bullish imbalance, right? You want a short inside a bearish imbalance, okay? But prior to the trade, everything can be mapped out here for you. Here's what I mean by that. You have your entry at some point inside of this imbalance. You can even say to yourself, I want to see us leave the imbalance before I enter. That's fine. If you're anticipating price to go up from that point, what's the problem with letting it show you get out of it? That's fine. You might be a little late. You might lose out on a couple points, but that's okay ultimately, right? As long as price is going where it's going and your entry is not, let's say, for example, up in this vicinity, right? We'll get to that in a second when we map ranges. But also, you have your stop loss just in case you're wrong. The low of the candle that creates that imbalance is always my stop loss on trades. Why? If I'm using this imbalance as a way for me to structure an idea, ultimately, if that low of the candle, if that candle is taken out, what is that telling me? That price inside this region is now balanced. And my idea to buy the imbalance in price, it's no longer valid. If price is balanced, then why am I still hanging on to a trade that's, it's balanced at this point. The price range is balanced. Price can move freely within that zone now because that candle has been voided, right? So it gives me a very sweet criteria as to where entry, exit, and even my take profit. That's going to be when we fall into the liquidity part of things, which we will get to. But simply put, you can go into the idea and say, okay, I want to buy this imbalance. My entry somewhere in the 10,845 range with a stop loss down here at 10.76. If that's too big for you, like there could be a situation where you have a pretty big range and it might not be something that you want to really, potentially be wrong on, right? Let's say it's $10, right? If you're looking at something like SPY, or maybe it's a $10 candle. That's too big for me. You don't need to trade it, right? It's all mapped out there for you. If that's something that makes sense, fantastic. If you're trading futures, you know exactly how much money you could potentially lose in that situation. 20 points for each point times however many points. That's your potential loss. And then multiply it to where you think price is going to go, times 20. There you go. You have your whole trade mapped out before you, right? So there's no more, oh shit, that loss was way bigger than I thought it was going to be, right? There's none of that. You don't have to worry about that anymore because it is all mapped out for you well in advance. And if it's too big, if it's too big of a risk, you could potentially lose more money than you would have liked to lose, then you don't have to take the trade, right? Go somewhere else. There's tons of names that you can look towards, right? Now with options, it's not going to be as simple, right? Because options, you have to deal with a couple other things, such as delta, gamma, theta, you name it. There's Greeks associated with those specific contracts that do influence the amount of money that you can make or lose in a certain situation, right? And if you don't really know all of those that well, that's fine. Just drop something in the comments right now. I'll take a look and I'll explain that a little bit more. But options contracts are a little bit different than what it would be like trading underlying stocks or futures, right? Where it's just cut and dry. I buy at 10, I sell at 11, I make $1 per. It's not necessarily the case with an options contract. You're dealing with a lot of other external factors, which we call the Greeks. But even still, right? Your delta is the probability that ultimately that contract ends up in the money, right? And if that's the case, where you're looking to see, okay, well, my delta is 60. That means and you'll see it on any options contract you ever buy, it's going to show you the delta, the gamma, the vega, and your theta, right? Every single one, it's going to show it. What the delta is telling you is if you have a 60 delta, that means for every $1 move that you have, $1 up, you're going to gain $60 per contract. If it goes down $1, you're going to lose $60 per contract. So you can essentially do the math on, let's say, let's say it was a $4 loss and your delta is 60. 4 times 60 being 240. I know the max that I can lose in this is going to be $240. Plus you got to add in a little theta. We'll get to that later. But that's what you could potentially lose. So when I hear people, oh, I got in and it knifed on me and I got stuck in it, and that, to me, that's a lame excuse. You can have this whole thing mapped out prior. If it voids your plan, then why are you still trading it, right? You need to kind of become regimented in a way where you don't even think twice about it. If it takes out the low of the candle that created your imbalance, you were wrong. And if you can't become good at accepting being wrong, then this might not be the right business for you, because this is something where no matter what, you're going to be wrong. I don't care if you're the best trader in the world, you're going to lose, right? It's just a part of things. And honestly, the more and more that you look to press buttons, the higher the probability you're going to run into a couple losses are. But are you going to allow yourself to lose 10 winning trades of progress in one trade because you don't know how to pull the stop loss? You don't know how to take that loss. We've had it here, actually. We've had people who have gone on insane runs and they've totally blew it on a week of bad trades and not respecting a stop loss, right? Because you're all going to get to the point where you feel very confident that you can kind of identify where price is likely to go. It always comes down to that execution. And with time, your execution is only going to get better and better. But at first, you really have to start to embed it in your brain that this trade was mapped out prior. If I'm not following my plan, whose fault is this, right? A lot of it comes back to you, and a lot of people can't handle that. So that's why I'm just being very, candid about this and straightforward, because like I said, using these methods, you will have a trade mapped out for you. Are they always going to be correct? Probably not. More often than not, I think you'll be right, but probably not. And if that's the case, can you take losses? If you can't take losses, you're going to be in some trouble, because those losses that you don't take turn into massive losses when you don't know when to pull the trigger on something, right? So the risk management part of it, and you're going to hear me talk about this a lot over the next month, but I don't buy the trading psychology. I think it's important, but I think that it's secondary to actually having an understanding of how price works and how the market actually moves. If you don't have that, then of course you're not going to know, you're going to be sweating trades, right? Your psychology is going to be all fucked up because you don't have a specific game plan in play, right? You just haven't done it enough. Of course you're going to be sweating. You don't have confidence in it. You haven't built up that confidence in yourself to actually trust and respect the trade plan that you have mapped out for you, right? So that just all little secondary stuff that comes into play when this is just trading in general. But let's see. Yes. So the next concept, and also if you have any questions about uh, imbalances at all, uh, put them in the chat right now, and we'll hammer it home. These are very important. Just how to map them. Okay. And you're going to hear, I tend to use the universal term imbalances, but there are two forms of imbalances that kind of fit into that one folder for me. And the first being the fair value gap, which when you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. I showed you guys here, right? A fair value gap, right? We have a buy side imbalance, an inefficiency to the sell side, and up here we have a sell side imbalance, buy side inefficiency, right? Buyers are inefficient in this area, creating that imbalance in price, ultimately pushing price lower. Okay. But the second form is something that I'm sure all of you who've been around for a little bit have seen or heard of before, and that's simply just a gap, right? If you have a gap higher, we call that a bullish volume imbalance, right? A gap lower, a bearish volume imbalance, right? Just gaps, but those gaps, they actually carry a lot more weight than what you might have thought. When you see a gap on the chart, a lot of the times they can kind of indicate the market's next move, right? If you're seeing a gap down up in premium of a range, we're going to get to the premium and discount, don't worry. But if you see one in premium, that's going to show you some urgency to move lower. If you see a gap up in discount of a range, oftentimes that's going to show you some urgency to get up and get going, right? Just all little things that you can add in as well. I just heard the Discord beep. I want to make sure. Okay, good. Yeah, no, I'm glad a lot of people who've been here for a while coming in just for a little refresher. But so that's first, imbalances. So nobody commented, so I'm guessing you guys got it. All right. Of course, if you have questions, feel free. But that'll be kind of step one. Now, step two, we'll go back up to liquidity, right? So this is arguably the most important concept that we're going to talk about. And this is ultimately, to me, where price movement stems from. And liquidity, just another word that you can use to associate with, would be money, right? Liquidity. The algorithm, which I hope that you all buy into by now, and if you're new here, I hope you will buy into it pretty shortly. But and again, not just from me saying it, but from seeing it for yourself, that this algorithm that delivers price is driven by money or liquidity, right? Now, ultimately, the whole idea here is for that algorithm to go chase liquidity. It's going to go to a liquidity target. And, you might be thinking, where the hell am I going to find that? To be honest, it's really not the most difficult thing, really. We're looking at key swing highs and swing lows, okay, as pools of liquidity, areas in which the market could likely go to, okay? Now, there's ultimately, and this is really the secret sauce behind trading, in my opinion, I think this is probably the biggest game changer for anybody, really. You can have a bozo using moving averages and trend lines, but if he has an understanding of the concept of liquidity, I think he'll probably do all right. But if we can get an idea as to where price is going based on our pools of liquidity, right, which you can, and I'll explain that next, that's market structure. But if you can get an idea of where price is going, that doesn't necessarily mean I need to buy this and hold it until we get up to buy side liquidity, right? Because there's a few red candles mixed in. You might want to take some profits. But if you're on the right side of this thing for the entirety of this range from discount to liquidity, buy side liquidity, which would be a swing high, sell side liquidity being a swing low, that's a lot of points that you're going to be on the right side of things for, right? This in itself is, 6,000 points. Do the math. 6,000 points times $20 per point. So that could be a lot of money. And again, you don't have to catch every single one of those points, but if you can catch a majority or a nice chunk of those, it's a pretty good feeling. That's a good amount of money that you can make, right? Now, how do we know which pool of liquidity the market is going to target? Is there a way for us to feel really good about it, right? And if you're here, you've probably seen me post stuff on Twitter. And when I post stuff on Twitter, the only way I'm posting on Twitter is if I feel really good about it happening, right? I don't want to be throwing out losers left and right? So, that component of it has actually helped me become better, because now if it's not clear as day, or I feel like it's clear as day, I'm not going to post it, because I don't want to have a bunch of clunkers and for idiots to attack me all over the place, right? Unless it's really high quality, I'm not really going to put it out there. But how do we identify which pool of liquidity we're likely to target? Well, we have something called market structure, or our trend, right? You've probably heard that word before. But how do we identify a trend, right? I'm not talking about using that line that people just do this and they try and use it to fit their narrative. That's the best, right? They just try and maneuver these like triangles all over the place to make it make sense, when it's just a load of shit. There's nothing to it, really. But how do we know in a way that we can backtest and prove it that this is something that actually works? Okay. So ultimately, all that we're looking for, and I'm going to use, we can go back to, let's do it on the weekly, actually. This way there's a little bit more humps and lows on a weekly time frame versus a monthly, which is really kind of pure, and price movement is pretty smooth. But let's take a look, okay? So I think it's fair at this point to say that, let's go back here, whoops. We took out this high, right? And this goes for any high or low. We can do this anywhere. I know we're going back to 2018, but I just want to show you the repetition over the last couple years. It's fair to say that we took out this high with what price run? Okay. From this low, swing low, to swing high. Fair? I think I would say that's a fair assessment, right? So we're looking for highs and lows to be taken out. If we take out a high, we are looking at a bullish trend. If we take out a swing low, we are looking at a bearish trend. And we're always going to be pivoting towards the higher time frame. The higher time frame, the stronger the setup is going to be, right? So if we have what would have been technically a bearish structure on a daily time frame, but our weekly, that's getting us down into discount, I'm going to pivot towards my higher time frame. My higher time frame is going to know all. We had something similar to this happen a couple months ago, where we had a weekly imbalance, bearish imbalance form on NASDAQ. But then you look into the monthly time frame and you see that weekly imbalance literally just brought us into a monthly bullish imbalance, and we took flight from there, right? So I'm always deferring to what I see on a higher time frame. And how we analyze this and really come to conclusions is something that I think it's going to be beyond one night. I don't want to overload anybody, but at this point, my model, the Mando model, where it all comes together using the ideas of imbalances, liquidity, and market structure, is as follows. After we take out a swing high or swing low, I'm going to map the range that does so. Okay, so this is the price run that took out that high, correct? Okay. Now from this point, you're going to notice that price does not hit this 50%. What that tells me is our range is not set. Why? Our range won't set until we get an opportunity at equilibrium or fair value for whatever the asset is. Okay, if we do not get to that 50%, there's really no interest to me, because to me, fair value of a range, or of whatever we're talking about, NASDAQ in this instance, is right in the middle of our high and our low. That is equilibrium, right down the pipe. Now, from this point, the way that I look at this specific range is anything above 50% is premium. I am overpaying for it above 50%. If it's below 50% in a bullish range, this is discounted, right? It is below fair value or equilibrium, right? So let's just pretend this is milk, and milk is $5, okay? $5, or generally $5. That's equilibrium. That's the midpoint value. Now, if you go to a place and you see, $7 for milk, you're probably, if it's a necessity and you need it, you might have to overpay for it, and that sucks because you could have went down the street and got it for $2 less, right? But if you see something that's discounted or on sale, you're probably more likely to buy that because it's discounted from its original value, its fair value. So if I don't get 50% on a retracement like so, all that tells me is that the range is not set, okay? So from this point, you're going to look again, and you're going to notice that, again, we didn't get discount. Damn, man, I'm missing out on all this opportunity. Just wait. Here we go. Right up to the high prior to COVID, okay? So you guys probably all know about the COVID crash, right? Quote unquote crash, that's what I call it. What is the COVID crash to me? Well, to me, this just looks like a discount retracement into, we have a couple, hold on, right here. There's one, and here's your second. This is what we would refer to as an inverse. Okay, ready? Discount retracement into a bullish imbalance. Hold on, where's this red one? Come on, give it to me. There it is. Prior to your run for highs. Okay. So, Mando, you were just talking to me about which pool of liquidity that we can target, why, what was that all about? When you have a bullish trend, when you've taken out a high, and you've seen 50% of a specific price range, go back and backtest this. Tell me how many times price gets into a discount bullish imbalance and takes off for buy side liquidity. Go check in the Manda model folder. You guys are all in the group. There's a zillion examples. This is the market. This is how price action works. Look, just because it's what I use, don't take it out of context. Do it yourself. And you're going to start to see, holy shit, okay, got it. Now watch this. After you get your discount retracement into a bullish imbalance for your run to highs to complete my model, what is one thing that is noteworthy inside the entirety of this? And, this is a broad question, so I'll give you the answer. If we're entering down here in discount, what's really our risk in this trade? Way less than 50% of our range to make way more than 50% of our range. If we're buying 79, right, it's lining up with 79%. We're not using Fibonacci. It's all just for measurement. But if we have an imbalance that down here, this is probably like 81, 82. We're scoring 82% of the range while only risking 18. Does that make sense to you? That makes sense to me. My reward is always way more than what my risk is going to be. And this is why this model, when I first got it put together and started to make sense of it, why it makes sense to me is because this is something that happens over and over and over again. And on top of that, if my reward is always going to outweigh my risk by a lot, that makes me feel pretty good, right? That makes me feel, okay, I can stop out 2 or 3 times. If I hit once, guess what? I erase those stop outs and still make money. That's the goal here, to really, and you might hear some people say, oh, the risk reward doesn't make sense if you know where price is going. Sure, but guess what? When people are just starting to learn how to do this, to have a better risk, have a better reward for your risk, to me makes a whole lot of sense, right? So, as we continue, we're almost done, I promise. Here's your low. Okay, what was the price run that took out our previous swing high pool of liquidity? Right here, and you see I have it labeled. What was that price run? Go through go to every single red candle or black candle. Ask yourself, do we see 50%? No. Okay, that's fine. Range is not set. Go to each red candle. Do we see 50%? Nope, we don't. What is that telling me? The range is not set. The range is not set. The range is not set. Aha! Got it. Low to our high. We now have an established range. This is something that I'll teach you guys after. I don't want to overload you, but when you see the first bearish imbalance happen, oftentimes that's telling you discount is coming. Okay? But from this point, you have a bullish trend. I think that's fair for everybody to say. We took out this high with that price run. Okay? We are now in discount of that bullish range. Okay? So with that, when you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. What can we look for? We can look for some sort of imbalance to be taking place in here. And I might just add that with where we currently sit on these NASDAQ contracts, they are adjusted over time, 3 or 4 times a year. Okay, so these levels might not be absolutely precise, but if you were to type in at Mando Trading within, I don't know, October 2022 in that tweet, you're going to see that we're going to have some sort of imbalance lining up. In this case, we have something called an order block, and this is for another time. But this is another form of an imbalance. It's for another time. Don't worry about this. You really don't even need to know about order blocks if you don't want to. But price gets down into this bullish imbalance down here in discount of your overarching bullish trend or bullish range. Okay. Now from this point, which pool of liquidity is more likely to happen? You can just refer back to, is our trend bullish or is our trend bearish? If our trend is bullish, where are we looking? Upper highs. Remember that bear market of 2022? Yeah, I just call it a discount retracement into a bullish imbalance. That's all. All it is. Just took a little bit more time than COVID did, but guess what? Same result. Price just gravitates towards discount, specifically an imbalance, ultimately running for our buy side liquidity target, which is our previous swing high. That's all it is, folks. Ready? I got another one for you. Okay? So, following our first shift in structure here. Okay? You guys remember that bank crisis that we had with Silicon Valley and all of that nonsense, right? You guys remember that? Well, what happened after taking out this high? What's our range that we can map out? From our low to our high. Fair? We took out this high with that price run. Okay? What do you notice here? What's in discount of this bullish range, right? When the bank started to blow up. No, we're just getting into discount bullish imbalance. Do you see why I don't give a shit about news? It doesn't matter to me whatsoever. Price is algorithmically delivered in a way in which it's something that is repeatable regardless of the news. I don't care. I'll go to any chart. I'll go to Tesla. I'll go to Apple. I'll go to Boeing from 1970. It doesn't matter. I don't have the earnings reports from back then. I don't know if they had wings blowing off the planes back then too, right? I don't know any of that shit. But price delivers this way since the beginning of time. We can go back to Boeing if you guys want to do that. I have a whole video of that. Going back to Boeing, we did FedEx, or maybe it was UPS. I forget one of those. We're going back 40 years. These concepts still work, right? Now here's your low to your high. Here's your discount, bullish imbalance. So right when we hit 50%, what is the more likely draw on liquidity? You're going to hear us all talking about that in this group. Draw on liquidity. That is the target, basically. Where do we think price is likely to go? Well, we have a bullish trend. We got our discount retracement. We got into a bullish imbalance. Ultimately, we're looking for highs here, right? We're looking for a continuation. And there it is. Bingo. Run for highs, okay? Now the same thing applies. We took out this high with what price run? From your low to your high. No discount retracement. That's okay. What is that telling us? The range isn't set. Don't worry. We'll get an opportunity. I feel good about that, okay? From your low to your high. Here is your discount retracement. Do we have a bullish imbalance? Sure do. There's your run for highs, right? Once we get to 50% and this range is set, where's price likely to go to? Our buy side draw or our sell side draw? Are we bullish or are we bearish? Well, we're bullish. We took out this high here with that price run. We're looking for this high. Guess what? Low, up and through. Mando model is complete. Okay. Now, how about this one? What we're about to complete here, and I fully anticipate this happening over the next couple, hopefully sooner, but probably over the next couple of weeks. What was the price run that took out this high right here? From your low, your previous discount retracement into a bullish imbalance, to your, go to each red candle, you're going to notice that our range was not set. Even after here, our range wasn't set, right? 50% we need. That's okay. Discount retracement below 50%, check. Bullish imbalance, check. Let me remove this. It's a previous bearish imbalance. We'll get to that another time also. Price gets into discount, bullish imbalance. We sweep liquidity. Is this our range setter? Nope. Low to high. Here's your discount retracement. We sweep liquidity, gather money. This is something called turtle soup. Again, for another time, I don't want to throw too much at you, but this is a layup. Run for highs. That's the expectation. And that's going to complete the Mando model yet again. And that's it. That is the Mando model. Imbalances, identifying liquidity, understanding current market structure. That's really it. That's my model right there in a nutshell. Now, oh, you're just showing me NASDAQ. What do you want to look at? We'll look at anything. You want to look at Apple? Sure, we can look at Apple. Do you want to look at Tesla? Go ahead. Let's go. Go through 100 names. Don't matter. Ready? We'll see an immediate one right here. Low to your high. Discount retracement, 50%. Bullish imbalance, right here. Run for, oh, not yet. It's coming. Ready? Here's another one. Low to your high. We took out this high right here with that price run. We didn't get discount. That's fine. Did we get it over here? Not quite. Okay. Big range. Wait, one more time. Whoops. There it is. Okay. There she blows. There she goes. Next. What's the next one you guys want to look at? We'll look at Microsoft. We'll go through all of them. Don't matter. Ready? Same situation here. From your low to your high. Here's your discount retracement into a bullish imbalance. There's your run for highs. Mando model complete. Why are we targeting this high? Our trend is bullish. We got into a discount bullish imbalance. Buy side, here we come. Okay. Next up, low to your, whoops. Go through each red candle. Let's see if we get discounted. Nope. Okay, that's fine. Let's see. Did we hit it there? No. Nope. 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 No discount retracements. That's okay. We can look towards our daily range. That's what I currently have mapped. Right? If we go to the daily, it's going to be much more clear. Ready? So if you're not in discount on a monthly time frame, that's okay. You can look at something like Meta. That takes 11 years to complete a discount retracement on a monthly time frame. But go over to your daily time frame. Clear as day. From your low, whoops, to your high. Here's your discount retracement. Here's your bullish imbalance. Here's your turtle soup. That's just an added layer. You don't need it, but there it is. So far, so good. Where's our buy side target for Microsoft? 468.35. Right? Let's go to Netflix. Okay. Where are we? Go through each one of these little price fluctuations. Okay. And you can go through every time we've taken out a high. What happens? Okay. We took out this high with what price run? Low to high. Bullish imbalance. Run for highs. Mando model complete. We took out this high right here with what price run? Low to high. Discount retracement. Bullish imbalance. Run for highs. Mando model complete. Low to your high. Discount retracement. Bullish imbalance. That's a gap up. Volume imbalance, right? We talked about that. Run for highs. Mando model complete. low to your high, discount retracement, bullish imbalance, run for highs. What's next? Go on forever. Low. This is what we're currently working with on our range on the weekly. Any more? We can go through any. Does it work on crypto? Sure. Low, high, discount retracement, bullish imbalance, run for highs. Low, high, discount retracement, bullish imbalance, run for highs. Low, high, whoops, discount retracement, bullish imbalance, run for highs. You starting to see it? Come on, tell me you're starting to see it. Nice, great. Integrity. I knew you were newer here, so I want to make sure of that. What do you think, guys? What do you think? And what do you think, Ibra? What do you think, Flow Hunter? What do you think, Greg? And the rest of you guys have been here. Joe, what about you? What are you guys thinking? Repeatable. You sure you want to see it on GME? I don't want to show it, but I will. Fuck. What do you see? What was the price run to take out all of these all-time highs previously? Low to your high. Look what we got on GME right now, folks. One big Mando model. Deep discount, bullish imbalance. Low, high, discount retracement. It's a matter of time, unfortunately. That's all it is. That's a great question. Let me read out the rest of the comments, and Gash, I'll get to yours. That's a great question. See, it seems like an easy way to trade. Yep, the way, ultimately, it's something that maps out the entirety of your trade. Therefore, if you are wrong, you're stopping out for minimal losses. If it's not going to be a minimal loss, then why are you taking the trade? It's too big for you. You know that before you even enter the trade. Why would you take it if you think it's too big for you, right? That's the beauty of it. You have an idea of where the target is. It's going to completely outweigh the potential loss that you're going to take. And if it doesn't, then why are you taking the trade? It's mapped out before. You know what it could possibly be before the trade. There's no getting caught with your pants down in this. It's always mapped out. Beautiful with this simplicity. No favorite indicators, no mess of a chart. Starting to better understand the price delivery helps you really establish a plan. Yep, absolutely. You don't need any indicators. Anybody who tells you that you do, they're full of shit. It's to me, that is much more distracting than anything else. The news, what you see on CNBC, what you see from 99% of these idiots on Twitter, it's all bullshit. You don't need any of it. If you learn how to read price and you can see that this is something that is extremely repeatable, and remember, we have 4 of these. This is just one. This is something that you can feast off of, and that's all it takes. One setup. You don't need to trade the same exact thing. You don't need to, stress yourself out. If it's not there, you're going to finally believe that, okay, I don't need to trade because I know the next time I get it, I'm going to hammer it and I'm going to set myself up for a couple weeks, right? Yep, new indicators are time and price. That's it. The time aspect of it is something that is very important that we will get to at some point. But again, I don't want to overload anybody right now. This is great. This is a great question. Once the model is complete, do you go to the next swing low to swing high? Absolutely. Okay? And this is, Gaj, where the inverse Mando model, and we've kind of dubbed it the odd nam, comes into play. Okay? So let me see if I could cherry pick an example here. Let's see. We haven't had many of them because we've been bullish for so long. Actually, let's just go back to NASDAQ. We'll go back to the quote-unquote bear market. Okay? So at what point do we really know when this range is done? Did we reach all buy side or liquidity swing high targets? Yeah, if we did, then guess what? Anything above all-time highs, I got nothing for you. We've never been up there. There's no money resting up there for the algorithm to go and get. I have no idea when big money is going to start to sell off, right? That's as candid and to me as simple as I can possibly put it. I have no idea when this thing is going to stop on Nasdaq. Could we go to 25? Sure. Where are you getting that number? I don't know. I'm guessing. That's literally what it is. Anybody telling you that we're going to 600 SPY is just, yeah, I think that's where it's going. I think. There's no fabric behind that. We've never been there. There's no reason for the algorithm to drive to that point. We can use that as a specific target. Yet, we don't know when big money's going to pull their money off the table. When they tell us it's time, it's time. Okay? And how do we know it's time for us to go see discount? When you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. Balance. Every single time that we've gone and seen discount in any of these price runs, back test it yourself, go look on any chart you want. Anytime we're about to go down to discount of the range, what do we see? Bearish imbalance. Okay. What do we see? Before we got down into discount right here. Okay, we got down into discount in August. Bearish imbalance. Every time. Every time we see discount, there's going to be a bearish imbalance. Bearish imbalance. Bearish imbalance. Look how price reacts to it. There it is. There was a few here, but our range was so quote unquote extended at this time from 2020 to 2021, end of 21. And we ranged that range from 8,000 to 18. That's 10,000 points before you got any sign of retracement. Bearish imbalance kind of sold it to you, right? But that is essentially the odd nam. When you see that bearish imbalance, you could look to play a retracement back into it and then ultimately look for discount. Not as big of a risk reward type win as what you can get with the Mando model, but still, so you're not sitting on your hands waiting for price to retrace down here, because this took a while. This bear market, quote unquote bear market, November down to, it was about a year of us steadily declining prior to getting to discount, right? Do you want to just sit here and wait a year before pressing another trade? Probably not. But it's just another thing that you can add to your toolbox as a way to identify a downside trade. That's the odd nam model. That's another thing that we're going to get to in much more detail as we continue on here over the next couple months. If you look at our third, again, I'm just going to briefly go over these. Our London kill zone model, that's much more futures or index based. It's not so much the individual names, but it's something that you can use to look for a quick hit in the morning, right? It doesn't even have to be the morning, but it's a quick hit based on the London range that you're seeing in your futures data. That's another one that we can use. And the last being that unicorn model, which that one's going to be a little bit more confusing right now, so I'm not going to explain it because I didn't teach you guys anything about breakers yet, but that's coming. And those are the most powerful, in my opinion, the most powerful type of imbalance that we can really look towards. They don't always occur, but when they do, they bang. So let me come back over here and make sure. Everything else will mess you up once you learn time and price. It's true. And I always say this, just to be fair, just because you're here doesn't mean that you have to trade like any of us. You don't have to do that, But if I can show you one thing that you can add into an existing model that separates you, that's fantastic. That's a win. But you'll notice that all of those people who come in here with their own model that trade off of whatever it is, moving averages, trend lines, whatever, when they, been here for a little bit, you'll notice that slowly but surely each one of those indicators start to fall off until your chart's looking like this with nothing. The two I have are time-based. New week open gap, something we'll get to, and then just it maps specific times on the chart that when I click that on, it'll show me the 9:30 open. Again, that's the time aspect of it. We will get to that. But in terms of overall price delivery, can't get much more simple than this. This is something that is repeatable. It's something you can go back on any chart and do this on. Just got to give it a little bit of time, a little bit of practice, and the more time and practice you put in, all that's going to do is expedite the process for you to feel good about doing this for yourself. And when you do, start to reap the benefits. LKZ, yeah. Let's see. Mostly we all trade differently off the same concepts. Yep, basically, right. And that's the beauty of it, because there's a lot of things that fall under this umbrella of like reading price, right? There's totally a lot of stuff. But at the end of the day, like I said, I led the whole thing off with this. You don't have to trade like me. You don't have to trade like KD. You don't have to trade like Sean. You don't have to trade like Ryan. You don't have to trade like Seeker. Go down the list. Cajun, Kyle, breaker model, right? Snaz. You all have different models, right? Now with that, what's the key takeaway to all of this? There might be one thing that sticks out to you. You might have heard me just talk about premium versus discount. That might be all you need. When we get into breakers, that's a big one, because a lot of people have literally just built their model off of breakers. I know Kyle trades off breakers quite a bit. That's I don't know if it's exclusively his thing. Yeah, no, Ibra, you're right. We all trade ICT, but there's just so many different ways to go about it. And really, for me, it took me a while to settle in, use one, which is my Mando model, right? But beyond that, I started to say, okay, well, I see that price loves to come to discount. There's got to be a way for me to identify this and capitalize on that discount retracement so I can play it both ways. And then I, through back testing, this one didn't take as long because it's something as simple as an imbalance showing you that price wants to go to discount. Then that's where the odd NAM or the inverse model came from. The kill zone is a time aspect, and that one's really smooth too. Take out a higher low of that London kill zone, look for the opposite side following an imbalance formation. Smooth, nothing too crazy. And then the unicorn needs to know what the breakers are, which we'll get to. That's just a patented setup. It's visual, but we will get to that. I don't want to throw it all at you at once, but you won't be a poor. You go 2 weeks of working normal times, and you go 2 weeks off where you're working overnight and stuff, and then you try to trade the overnight, and it's not always great. But anyways, that is all I have. So for anybody in here who has any questions based on anything that we talked about tonight, feel free to send it over. I'll happy to answer any of your questions. And to me, I take pride in being able to answer the questions that are asked. When you ask somebody a question and they don't know what the hell they're talking about, they don't even address the question. I'll always address your question because I feel like with my model, I know all the ins and outs. Everything that you could possibly ask me about it, I feel confident to give you an example and an explanation as to why something would work, why something would not work. All right. So this is a lot of hours at work, what I just showed you there. I wish it was an hour long when I was putting it together, but that takes a lot of time. Snaz, I have it recorded. Don't worry. I'll put it on YouTube and I'll send it. But that's all I got. So again, if you have any questions about anything here, if you're struggling, if you're 3 weeks in and you're like, shoot, man, I got to figure this out. I'm falling behind a little bit. Just shoot me a message. We'll get it sorted out. Don't stress it. And don't be so eager to push buttons. If it takes you a little bit of time before you feel good about it, that's probably going to save you some stop out money along the way. Just take your time, learn the concepts, and when you learn the concepts, you're going to see how trading becomes fun. But that's all I got. So yeah, they're coming. Our lives like these are coming back October 1. So I just want to get some of the newer people here to get in the mix a little bit, just have somewhat of an idea, just so when we do start rolling, they're not completely behind. So, but all right, I'll catch everybody later on. See you. to stop playing the lottery and actually learn how to do this? Come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. Alright, what's going on everybody? Mando Trading here, and in this video I'm going to be talking about my trading model. This strategy is one that I use in 90 to 95% of the trades I take. I am starting to incorporate one additional little setup that I can use to my benefit. So I'm kind of in the process of back testing that right now, but right now this is it. This is the model that I use for every trade. It's one that can translate well through different time frames as well. But before we get into it, just make sure you like, subscribe, share the video, do whatever you got to do, and I'd appreciate that. So let's get into it. First and foremost, this is going to be the first of multiple videos in which I dive into live examples. Now, I've been posting on TikTok, Instagram, even on Twitter, videos, and those are live trades that I'm taking in Discord. And you'll notice now after I explain it in this video that a lot of those trades look very similar, and it's because it's all coming from one setup. Nothing really is changing. I'm totally against the idea of chasing a trade when something takes off and you're trying to take a crack at it trying to catch that breakout or something like that. To me, that is just not a sustainable model. So for this model, it's important to have a basic understanding of three concepts. These three concepts are all derived from Smart Money Concepts, or ICT. I can link the videos in which those are taught down below in the description. So the three being: one, liquidity. Having an understanding of liquidity is really the most important thing to me, anything trading. The second would be the idea of a market structure shift. Which direction do we think the market is going to go, and why do we think that? And the third being a imbalance, fair value gap, an order block. Those are, or a breaker even. There are multiple different what he would call a PD array that I've incorporated into my model here, and it's all coming in a specific level that is derived from my market structure shift, and where I'm taking profits or targets is the liquidity. So it all comes together in that way. Now, while I have back tested this, I use it every day. I try and post. I really record 90% of the trades that I take, and I do that because I want to one, use that for my own study and my own back testing, but also just to share with you guys. And now you'll be able to see after seeing this video and the breakdown, how all these trades are pretty much the same type of thing. So, all right, now to get into it, just briefly, of course, like any other strategy that you would ever use, none of these are 100% effective. There are certain times where you might get a market structure shift, and I have my setup all there, it's perfectly there for you, and it breaks down and it heads lower. A reason for that happening would be, potentially we ran into a higher time frame level or resistance, that kind of shifted market structure, or shifted the momentum of what we were playing. So, again, it's not, nothing is going to be 100% effective, but even when it doesn't work in your favor, you always have a clear-cut criteria in which you can kind of make your decisions off of. So let's get into it here. So right now, obviously on the screen, I have the S&P 500 SPY 30-minute. So for anybody who's followed any of my content in the past, you know that I chart on ES and NQ, and those are the futures tickers for the S&P and for NASDAQ. And the reason why I do that is just because I'm getting more of a sample size. I'm getting additional levels from the overnight sessions from Europe, Asia, wherever it may be. The market is alive in other places. So to me, rather than having a gap, I would much rather have specific levels that I can use and, throw those in throughout the day. And, that'll be an extra layer that I might have that others might not. So, but anyways, for now we can look at SPY. It's fine. So I'm looking at SPY in the 30-minute time frame here. So this right here is a bullish imbalance or bullish fair value gap right here, and we can zoom back to see where that came from and where that was originated. So this dates back to Wednesday, July 12th, and just to give a basic little overview on what it is and what it looks like, I would recommend that everybody kind of take a look at some of those videos that I spoke on before, because that is a crucial component to my strategy. And I'm going to show four examples of this, two that perfectly meet my criteria, two that I would absolutely take trades on if I were to trade individual names, and then there's two where the idea still worked, but it wouldn't be as favorable for me to take it, and I'll explain why when we get into it. So first and foremost, we will go into SPY, and as you can see, we take a bounce right here, right? So what I'm looking for up until this point right here, we are still currently in a bearish structure, right, or a bearish trend. And the reason I say that is because every time we take out a low, to me, that is remaining in that bearish stance, right? If we don't take out a high, to me, nothing changes. So even on this little price run here, do we really take out any highs in this process over in this area? Not quite. So this would remain bearish, and you can see we take out another low. So from this point here, we have our low, we have our bearish market structure. Now we get our shift. Where would our shift be? So what is our recent high that we had? We have this high here, and we have a couple in this vicinity here as well, right? So what price run was it that took out this high right here? And it was this one right here. So this is where I have my fibs. I'm not a Fibonacci trader by any means, but I do use them for measurements. I think that it's a great tool to add just to have an overall understanding of the range that we're trading in. And again, you're going to see why I use it and why I feel like it is important. Well, it's extremely important for me, but why it would be important just for anybody really who's just trying to understand, what is the trading range, where might we run into some trouble, where might we run into some level that could offer us a bounce, little things like that that you can incorporate that'll, hopefully be helpful to you. So anyways, yeah, we took out this swing high here, or even these, right, with this price run here. So this is where I'm mapping out my fibs, right, from low to high. Now we come back over into here. So right off the cut, I'm deleting this just for a second. I personally I don't want to try and catch this, right? Because I know when liquidity or swing high is taken out, oftentimes that is taking out stop losses just in order to generate another move. Could it be up? Yeah, and that's when you get those breakout trades, but those don't happen quite as often as liquidity grab and retracement back down lower, where you're taking out stop losses and heading back down. So from this point, right, could you short this? And I actually made a little bit of a video on this the other day. Could you short it? You can try, but you don't necessarily know where this high is, right? You have the range set, sure. But for example, I mean, this is really a small sample size, but for example, let's say you caught this to the absolute tick, right? and you said, okay, I'm gonna, place my stop loss right above it, there's a chance that, with that short, right, we obviously ended up down here, so you'd be in the green for a moment, but price came back up and you actually would have been red on that trade. So a lot of people tend to get stopped out on that, myself included, when I do try and jump the gun a little bit and take those shorts, because I really want, and I'm expecting price after a high or low is formed to be retracing back down into what ICT would consider that optimal trade entry. And what that is down into this 0.62 to 0.79 range. Now 50%, usually that tends to be a battleground where you see this type of price action here, where it really is a battle. Are we remaining bullish? Are we going to be bearish? And there are times where, if you're looking at both NASDAQ and SPY, you'll see that, sometimes, let's say SPY gets down into, this, golden pocket little area, this 0.62 to the 0.79, and NASDAQ, it'll just tick 50 and take off, right? Especially if there's an imbalance in that area. So, for me personally, I would prefer, the lowest, in a sense, imbalance that has occurred. So in this price run here that we're looking at right now, we have one, just one. And here it is. You have wick, body, wick. This is your fair value gap right in this area here. And it is, right, it starts a little bit above 50%. So now how would I play this? How would this make any sense to anybody, right? So essentially what I'm doing is, as I'm seeing this form, I'm starting to salivate a little bit. I'm getting ready, because I know once we get a high set, right, typically, I would wait to even throw this fib on until I saw a high get taken out. But as that high gets taken out, I'm waiting for this retracement back down lower. Now, with these imbalances, this one started at least above the 50%. I'm not looking for those. Sometimes there could be an imbalance up here. I'm not looking at that one as a viable entry or exit. I'm not even trying to play that. If it bounces into it and takes off, it leaves without me, and that's fine. I'm looking for the best risk reward. I want them below the 50% level, which would be considered a discount on your long, right? If you're buying up here, you're buying a premium at a higher price. Whereas if you're letting it get below the 50% of it, that would be considered your discount. So as price retraces back down, in situations where this happens, you could check the videos that I use, where you get a little bit above the 50%, and the imbalance drops down a little bit lower. I tend to not enter this trade until we get to at least the 50% line. Now, sometimes that range can be really, really big, and if that's the case, I'll try and crunch it, and I'll try and look for a lower entry point within that same imbalance. But it's not always the case, right? Because, again, the wicks, oftentimes, they can really kill you if you're just solely going off your imbalance, right? So let's say as price gets in, we take our entry off the 50%. The way that I structure it and the way that I have my stop loss set is, one, depending on the range, right, how big it is. If it's a huge, huge range, oftentimes I'm not letting it get all the way down to this swing low. I'd probably just wait for a candle close right below that 0.79, and if that happens, I'm out. To me, that would show me some willingness to go lower and take out that swing low. But in a range like this, where it's really not all that big, and if I'm looking at a 30-minute time frame, this is not going to be like a day trade for me. This would be a longer term trade. I would have my stop loss essentially right below this swing low right here, because what would happen if we took out that swing low? To me, that would be a market structure shift, right? So I would have my entry somewhere in below the 50% level, ideally between this 0.62 to 0.79, in some sort of imbalance, which is, it looks like a little gap in the chart, right? A volume imbalance, gap up. You have fair value gaps right here. You have bullish breakers. That's another concept that he teaches. You can look at it if you were more interested in that. An order block, another concept that you can look at. And I'm using one of those. I'm not just solely going off of the Fibonacci's, right? Does it work sometimes? You're going to see in a second how it does. But to me, that's not giving me the level of confidence I need to feel safe in that trade. And again, you know, I do take quite a few trades because, again, like I said, you know, right now we're looking at the 30-minute. We could do this on the 5-minute chart as well. So it does occur quite often. And of course, they're not always right, but more often than not, they play out pretty dang well. And you know, to me, the highest probability is when you get one of these bullish imbalances in this happy zone, right? So we talked about imbalances, we talked about our market structure shift. Now, just to briefly talk about, you know, the concept of liquidity and where would I be searching for liquidity or my profit taking target, right? So we have liquidity resting here. We have liquidity resting here, which is our swing low, right? And we have liquidity resting here, which is our swing high, right, that we just set following that market structure shift and break of this recent high. So as price gets down into this area, I'm looking at my first target being this high right here. So just getting back to the high in the first place, that could be target numero uno, right? And from that point, that's a pretty decent trade, right? So let's say we did enter it off the 50% and we got in at 445 and we took that thing up almost $2 just to get back to our recent high, right? So from that point, that trade would work out solid, right? So we reach above and we take liquidity. Now, first target, depending on, you know, what kind of trade you're taking, do you have time on the contract, or are you trading short dated contracts like I typically do? In that case, I'm usually a little bit more quick, and that's why if you see my videos, you'll see me sliding my stops up in profit once we hit specific zones. So, you know, for me, if I'm carrying multiple contracts, my first scale out would be up at this area, and I would be moving my stop loss above, you know, maybe a newfound you know, imbalance or something like that. And at that point, if it were to come back down and take me out, so be it. But I'm locking in points regardless. I'm not going to go and let this good trade go bad. So that's why I move my stops and profit. And in addition to that, NASDAQ is $20 per point. That can turn into a lot of money. I actually have a trade today that I kind of fudged up. So I moved my stop up, but I was being a little more stingy with it and not moving it as high as I probably should have, because I wanted a higher target, and I got stopped out of that trade. We ended up just chopping, really. I didn't miss out on too much until way later on in the day, so it didn't turn out to be a big deal, but I did, you know, let a couple $100 just kind of fade away from me when it was pretty easily avoidable. So, but as we continue here, we come up, we take liquidity here, and after that liquidity grab, what do? We don't break out, right? We pull back and we head lower again, back to where? This golden pocket area once again, and we start to make our move higher just again. And this is active. This is what we're seeing. You know, today is August 14th. I'm actually making this video at midnight on the 15th. So as you can see, we make that run up higher, get back down into fair value gap here, and we take off again. Now, the way that I look at it from a short-term time frame perspective, like I do intraday, once we take out that high, for example, we take out this high here, this is all I'd be doing. Oh, not that. Whoops, let me leave that down there for a sec. This is all I would be doing. And looking at the same type of setup here. So what price run was it that took out this high right here? It was this one. Boom. Did we get back down into 50%? Nope. Not a trade that I would ideally take. Did I miss something? Yeah, I did for sure. But in terms of risk reward for me, this is where I want to be adding off of to be, you know, taking this thing higher. So that's just one example right there on how, you know, my model in a nutshell. We could take a look at Apple here. Apple's got something very similar here in that we set our low, right? Bounce perfectly off this bullish. If you're looking for a market newsletter, check out mine, Markets with Mando. It's recently been featured on Benzinga, Webull, TOS. First month free using code August100. I'll put the link in the bio. Imbalance from the other day. We took out swing high right here. Market structure shift, right? Here, our imbalance is right at 50%. Okay, so that kind of throws a little bit of a wrench in things. But right here, we have a bullish order block. And on the 5-minute chart, I'm not in love with taking order blocks in this type of situation. I really prefer the bullish fair value gaps or volume imbalances, or breakers, or maybe we're at the new week open gap, things like that. I would value more than a smaller time frame order block. That's just me. That's how I feel about it from back testing. If you feel differently, drop a comment and let me know, but that's just how I kind of feel about it. But anyways, still stay true. This, we remain into this bullish imbalance here. Never drops below what essentially our stop loss would be in this situation. Now again, if the risk is too much for you, you have to be able to map that out yourself and identify, okay, my risk is different than Mando's. Maybe I got way more money than him and I can risk way more. Or maybe, I don't have as big of an account and I can't, right? So what? Who cares? You just have to be able to identify that for yourself and just have an understanding of, if price gets down to here, where's your contract going to be at, right? Whatever you're trading, where are your shares going to be at? What's your position going to look like? You have to kind of forecast that before anything else, or you're kind of, you're playing with fire a little bit. So regardless, this works out a little bit more sloppy, but we really held on to this throughout. Still held within our 0.62 to 0.79 and this bullish order block right here, and we run higher. We don't quite make it up here. Takes one more chance. We actually gap up, take out liquidity here, and as we simmer back down into our bullish imbalance at the 50% level, we take off again and we continue higher. So a little bit more sloppy, but still concept carries, right? Just for time purposes, we'll keep on speeding through because I got a couple more I want to show. Here's Tesla, same situation. Find support, take out a high, set our range, right? Boom, boom, here's our range. We get a dip into a bullish imbalance in discount or below the 50%, and we start to move higher. This one didn't even take place yet. We do have a pretty substantial gap down or bearish volume imbalance here. So would I expect an explosive move? Not necessarily, but still the same rules would apply. Like my take profit would be here and my stop loss would be under here. So always well-defined risk. I'm never going into it not having an understanding of where I would be stopping out or where I'd be taking profits, right? Profit target number one. Next target for me would be our next swing high, or our next area of liquidity, which is another, 4 points higher, 3 points higher. Again, here's another example, and this is actually an example where one that I probably would not take. So as you can see here, what price run was it that we took out this swing high right here? This is, right, we can all agree that this is the most recent swing high that we had made, right? We could also look at it like this. If you wanted to say, okay, we took out this little high here with that price run, you can look at it like this. Same situation. Boom. Got into our 0.60 to 0.79. Take off. Okay. Boom. Next. What high took out, or what price run took out that high right here? This one, from low to high. Right. We get our retracement back down. And while our little 0.62 to 0.79 golden pocket area holds up, right? Wicks do the damage. Bodies are what kind of telling you the story, right? So the wicks will give you the heart attack, but bodies held this the entire time. So as clean as this might look, to me, this is not a trade. One, all we have here is really an order block that makes me feel any sense of confidence. There's no imbalances in this area here. To me, not something that I'd be super interested in taking. Now, following this move, and as we break above liquidity, we do the similar type of situation right here. Boom. We can scroll on over, right, and come to this point. What price run was it that took out this high here? It was, boom. Okay,
just like Apple, or was it Apple, or was it SPY? I forget. One of them. Price runs higher, takes out swing high, retracement, back lower. Did it get into discount or below 50%? This would be the one that I'm looking for. Did I miss it? Yes. Am I going to cry about it? No, not really. Just as a way to control my risk. There's many other things I could trade, and these occur, multiple times throughout the day. But we hit a volume imbalance here, and we took off, created another imbalance in the process. Let's see, Amazon. Let's see, was this one that it was pretty beautifully? No, this is another one where, did it work? Yes. Would it be one that I would take? Not really. So again, we actually didn't even take liquidity on Amazon here. We were kind of stuck within a range. So you have your swing low here, or swing high there, sorry. Come on down here. Boom. Price runs higher, takes out this swing high. Here's our range set. Price retraces back into where? 0.62 to 0.79. Yes, we do chop around. We actually made relative equal highs. So retail traders who believe in that kind of stuff are going to say, oh, look, double top, oh, triple top, what? Nope, you're getting ripped. Boom. That's a lot of liquidity there. Market's going to search for that and rip their face off. So again, you can look at it from this perspective, just like we did on the other two. Okay. Now, what swing high was it that what price run was it that took out that swing high right here? It was this one. Run up, retracement where? Beautiful, 0.62 to 0.79. We have a bullish fair value gap right here, and boom, take off. Perfect. Right? And here's the last one, and this is even on like a name that might not get as much love because it's it's not a mega cap or anything like that, but similar situation. What price run was it that took out this swing high here? Low to high, retracement back lower. Did it get into 50%? No, I'm not interested. Price does run a little higher, takes out a high. As we come back down, same range. Where does price retrace into? This bullish volume imbalance, which is a gap essentially. Sometimes you even get these on a 5-minute chart on ES, so that's why I think they're so valuable, because they do act as support, and people often don't even look at them like in that way. So, and that's another thing, the whole way I play gaps and stuff. I can make another video about that another time. But price gets into this 0.62 area here. Boom, we hold it. Did we take out the swing low? No, you never would have got stopped out. So the wick would have given you a heart attack here. Body held, and we took off. Head up towards, did we take out first target? Yes. What would our second target be? It would be our next swing high. So this one essentially, did we reach it? Yes. In this situation here, could you just keep sliding stops up into profit? Absolutely. And that's the way I typically do it. Not many of my trades, if you look on Instagram, TikTok, even on Twitter, X, whatever it is, you'll notice that a lot of the times I let that thing run until it doesn't want to run anymore. So am I missing out on a couple bucks? For sure, but I would prefer doing that than to be taking profits when I think there could potentially be more to it. So really that's all I have. I mean, here's just one more quick brief example. I mean, this is even on the daily time frame. This is what I've been looking at, and I don't want to say I was bullish over the last couple weeks. Do I expect higher prices? I am in that bull camp. It's just my thesis, but I had a good feeling that we were going to come back down. Look, so again, which price run took out the high? Boom, right here. This is your swing high that we took out with what? This price run. Bang, right? And here goes back to that point I made before. Do I know where the top is? I could have thought this was the top of this specific range, and look what would have happened. Yeah, it would have been in the green for a little bit, but bang, range was not set. So that's why when we're in a bullish trend, I try to avoid shorting these moves down. Does that mean on a daily time frame I didn't take any short over the last 2 weeks? No, the 5-minute chart is completely different. But just for the purpose of understanding, if I was trading on say a daily time frame, I would expect this to happen. I just don't know where the top would be. So I would wait for some sort of imbalance to form, i.e. this, right? And that would give me a little bit more of an indication that we are going to head down. Now, I ran into a little bit of, I don't want to say trouble, but, I was, to me, I was kind of fighting with myself. Which imbalance did I think would be more favorable for a bounce? And, as we could see so far, this is still, we really haven't made up too much ground. We are down quite a bit from our highs, but we set our range. We retraced back down below 50% into a discount fair value gap, while the bodies still have held this bullish fair value gap right here. We did dip into this one with wicks, maintaining the 0.79, and we started to make a little bit of a move higher. And again, this is for me, I've been saying it on Twitter. This right here, if this were to fall, that would be a market structure shift to the downside, and at that point I would start to be a little bearish. Now, even with that break, I would still expect a move back up into, again, we could just flip this thing around, but it's a little bit more difficult to do with ES right now, because every single time this has happened, it's been a run. I mean, let's see, we could speed through this really quick. I know this video is pretty long, but again, this is essentially everything that I'm trading with. So let's see, first one, took out that swing high with what price run? It was this one here. Boom, boom. Where do we retrace to? 50% fair value gap. Boom, take off. Same situation. Where do we retrace to? Boom, take off. And we can literally just walk the line up this entire way with this exact setup. So this high taken out with what price run? Boom, boom. Where do we get to? 50% take off. Okay. And we can keep doing this. So this swing high here, what price run took it out? This one right here. Boom. Okay, where do we retrace to? Discount below 50%, fair value gap. Boom, take off, back to the highs here, and so on and so forth. So yeah, that's all I got. Sorry, this was a little bit longer than I had anticipated, but this is literally, that's my model right there, and that's what I use on a 5-minute time frame, 15-minute time frame, 30, daily, weekly, whatever it may be. This is what I'm using. I am working on incorporating one little thing that I think will be good when there is some downtime on some of these retracements and stuff like that. So well, I hope you liked it. If you made it this far, congratulations. I appreciate your support, and shoot me a message if you watch this video, and let me know what you think. Most of my videos from now on, I'm gonna kind of retrace back into this video and kind of show how it may have played out, may have not played out, and kind of how I manage it. So until next time, I will talk to you soon.